So thanks everyone for joining us tonight for our bombshell webinar regarding the ceasing of the LRBA arrangement for residential property in self-managed super funds. I think it would be fair to say this probably came as a bit of a shock to all parties other than the Treasurer. It came in quickly and quickly passed both houses of Parliament and became legislation really before there was a response. As early as today, the Self-Managed Super Fund Association of Australia president has been lobbying the government to broaden the scope of the LRBA and SMSFs from commercial property as it stands at the moment to including new builds the way is allowable in an individual's names. So I guess we watch this space to see if there's any changes there. Tonight, we're just going through the reality check of what's occurred, what our options are moving forward under the current regime, our 4-week roadmap of webinars to go through these options, and then obviously what I would expect to be a fairly vigorous Q&A at the end. So Tristan, if you could, we'll go to part one. So previously, as we all know, we could borrow up to 80%, in some cases 90% in an SMSF to purchase a residential property, effectively negatively gearing it within the superannuation structure depending on its income. That has been banned outright for residential property. The only options left remaining is to purchase a property outright with cash or use a related trust, ungeared unit trust structure to pool capital from other assets. Under the old regime, under the old system, you had specialist lenders providing the loans. Now, for residential properties, there is no lending. Commercial property can still be purchased using an LRBA arrangement. I've spoken to a number of brokers who have been kind enough to go out to what I believe would be most of the lenders in the marketplace, and they are still intending to offer LRBA loans for commercial properties, which is really good because it means that there will be a market for existing residential property loans under the LRB arrangement as at 17th of August. Under the old regime, you needed 150 to 200K to leverage into $1 million property or more. This made it highly accessible to a lot of clients, particularly younger people. Now that has changed. If your super fund is going to be the outright owner of a residential investment property, it needs the full purchase price in cash, which obviously changes the number of people for whom are able to undertake this. One of the real shames of it all is the attractiveness of the LRBA arrangement to people has been they are distrustful of the share market or concerned about a correction, particularly given the expansion of the NASDAQ in the US with the AI boom. And so they were very keen to have their superannuation, which is now substantial, invested in property rather than the shares to take the volatility out. Under the old rules, your SMSF formed a bear trust within itself. The bear trust then took out a mortgage with the bank. It was simple, it was easy to explain, people understood it. Unfortunately now, the structures that make super able to pool assets from outside are a little bit more complex and take somewhat more care in setting them up and also in managing them. Division 296 tax is also an issue. Under the old regime, there was limited exposure for most SMSF investors. There's now an expanded exposure for higher net worth people. Obviously, if you want to buy a property that's worth $5 or $6 million, you have a Division 296 tax problem. That can be assisted with a unit trust type structure. but it still exists as an issue moving forward. So Tristan, if we could have slide 2, please. So obviously we're all aware that Labor and the Greens cut a deal. Labor basically went to the Greens to get them to support their budget, and banning SMSFs from buying residential property was sold to the Greens as a loophole and, offered up as a sacrificial lamb to get their vote for the budget, which they attained. It was very last minute, and I think there's been limited commentary about it purely from the point of view that, A, it's a small section of the market. Less than 1% of residential investment loans are LRBA structures. So it's pretty small in the scheme of things. Interestingly, a lot was made about the risk of buying property in superannuation. If you look at property, direct property and residential property exclusively within the SMSF sector, represents less than 6%. So it's, I guess, a philosophical opinion for the individual whether or not that's taking excessive risk or not. For the industry, obviously the Treasurer felt that it was. It'd be interesting to compare that exposure to AI over exuberance in the US, but we won't have that conversation this evening. So it was predominantly political pressure to get the budget across the line. What it really means is LRBA structures are still available for SMSFs to use. You can still take out an LRBA loan. Your super fund can have it done within itself. It just can't purchase residential property. So from now on, it's got to be commercial property. Tristan, can we have the next slide, please? Okay, so the immediate pressure point has been caused in a large extent by 12% super. So if you think about it, SMSF is viable from about 200 grand onwards, if not more, maybe 300 grand. 12% super means that a couple on median income is reaching 300,000 in super combined much earlier in their life. So that used to happen when people were in their mid to late 40s, going back a period of time. That's now happening when people are in their late 30s. So, it's really pushed the SMSF sector to being economically viable a decade earlier in people's lives. Those people that are becoming able to purchase property in their super funds, because they're younger, they're looking at it as a longer term investment, and they love the concept of it being less volatile and they perceive it to have less risk than purchasing shares. And that was the popularity of property and super. Existing structures relying on bank debt now face a legal exposure. Continuing to offer residential LRBAs is pretty risky now. We're fast approaching a point where we just won't get that across the line. And we're talking in probably next week. So, that's an issue. And the active pipeline of deals that buyers agents, mortgage brokers, real estate agents and whatnot had in the pipeline ended basically on that day. So an interesting fact, I have clients who are real estate agents, obviously. One in particular is an agent on the North Shore of Sydney. They have 12 employed agents. And from the 1st of June to the 30th of June, they closed 2 sales. So that's a stunning turnaround for them. And, I would say there's a number of buyers agents, financial planners, mortgage brokers who had specialised in the LRBA field. Their businesses are now obviously no longer going to operate. They need to segue into commercial or look at a longer term strategy of property investment using all resources, not just super. Tristan, can we go to the next slide, please? So how to adapt? Obviously, we can't do residential LRBAs anymore, full stop. So it's just not an option. So we've got to look at, if we want our super invested in property and we've got, less than $1 million in there, we need to look at pooling our SMSF resources or our superannuation resources with our equity resources externally to super funds. I've been doing this for a lot of years using ungeared unit trusts. So what we usually do in that circumstance is we do a feasibility of what are the resources available. So we have X amount of resources in super. We are able to do an equity release loan against personal assets we currently hold. And then we pool those two pools of cash into an ungeared unit trust and invest via the unit trust using that cash and no additional borrowing. Our existing structures, we've got to be pretty careful with LRBAs. I would be very careful about refinancing LRBA loans. Not to say that it shouldn't be done, but I would be very cautious about it. I would not be making any moves in that regard unless there was an absolute certainty of proceeding. Because with an ungeared unit trust, there's no borrowing, we have none of these issues. So it's a related unit, it's a related trust. It's allowable under the SIS Act. It's not using any borrowing that's related to the super fund, and the super fund's assets are protected because there's basically no lenders or creditors that can attack it. So it's very safe and flexible from that perspective, and it absolutely gets your super invested in direct property exposure that you control and no one else. Clients that are relying on bank leverage, as I said, to use their super moving forward now, they either got LRBA using commercial property, that's still allowable. And it is my understanding from industry knowledge that lenders are still keen to lend to that. This has been in place for over 10 years. The ungeared unit trust structure has been in place for well over 10 years. So there's no rush legislation changes likely. It's clean, it's compliant, and it basically makes everything possible through pooling capital, which is, I think, going to be a key strategy moving forward, given all of the changes that have occurred in the last 6 weeks. Tristan, could we have the next slide, please? So, 4 client types. The cash-ready investor. Clients have accumulated, $1 million plus in super. They want it in property. They can simply just go pay cash for it. That's pretty straightforward. High net worth people. Something to consider there, though, is Division 296. If they're buying property and they're pushing above that $3 million cap in their super funds, an effective strategy would be for high net worths, form an ungeared unit trust, even if they put a limited amount of personal capital into that unit trust, 50, 100 grand, and put the rest of the capital required for the property purchase from their super fund. It means that if the value of that property goes up substantially down the track, they can personally purchase units from their unit trust, from the super fund that's invested in the unit trust, and wind their superannuation balance down by making pension payments or the like after age 60. Capital pooling, obviously, if clients with 250 in super, 350 outside, they can undertake a unit trust to purchase a project for 600,000 thereabouts. Your unit trust has got to be compliant. There's slightly different rules in some states you got to be careful of, but it's pretty straightforward once you've got the fund set up. The next webinar we'll do after that one is tangible asset advantage, investors wanting to move retirement capital away from managed funds and shares. Obviously, that's been a motivation of investing in property via SMSF for a long time. and also the commercial exemption. So very popular, been doing it for many years. Business person buys their premise in their super fund, uses an LRBA. Their business can then rent the property. Their super guarantee goes into the super fund as well, pays down the loan. So that's our 4-week series that we'll be doing. We may extend that out for other subjects. There's a whole raft of strategy opportunities involved in this. So we'll look forward to having any suggestions on additional subjects that people might like to undertake. Tristan, can you just go to the last slide, please? So your individual sessions, if you want to invite your clients to them, Cash Ready is obviously a high net worth seminar. How do high net worth use it? What are the additional strategy opportunities that they have in undertaking an ungeared unit trust structure, such as involving children in the unit trust, managing Division 296 tax, estate planning as well, using the unit trust. So it's a fairly powerful tool for those high net worth people. Capital pooling, where the SMSF can't make an outright purchase on its own, family trust or personal savings, bridging the gap via the ungeared unit trusts. Can also be business people that have got accumulated earnings in their companies, can do a Div 7A loan out to themselves, then use that capital to invest in the unit trust, buying the property. So there's a lot of and once again, a broad range of strategic options there. What do we do where investors specifically say, I have 300 grand in super, it's in shares and managed funds, I'm losing sleep over a property crash in the share markets, AI boom busting, whatever. What can we do? And we'll be just going through, LRBA for commercial, but also once again, sort of bringing in there, how do we convert it to property? Do we simply undertake an LRBA and buy commercial property? Do we pool our assets with someone else? Week 4 will be specifically looking at the commercial exemption. So business owners buying their premise, maybe younger investors are going to look at doing small commercial units initially and then building that up over time and churning them out, bearing in mind that commercial property, once a SMSF has owned it, even if it's in the accumulation stage, after 12 months, it only pays 10% in tax on the capital gain. So you go buy yourself a off-the-plan commercial unit over 5 years, it doubles in value potentially. So you've made a $200,000 capital gain on that unit, excluding a more complicated calculation. Let's just say it's 200 grand, you're gonna pay 20 grand in tax. So it's a powerful tool still to manage tax liabilities on property investments. Tristan, can we just go to the next slide, please? Okay, so just to recap, if your client has an active LRBA contract and it's mid-settlement, we can still get those settles up to the 17th of August. So what that means is if you've got exchange contracts on that day, my understanding at the moment, and this is changing almost daily, but my understanding currently at the time of this webinar is that those arrangements will be allowable to complete. Commercial LRBAs are still viable. Banks are still lending to them. That goes for all forms of commercial property. Ungeared unit trust can be structured pretty fast. The big hold up with any of these structures is really the rollovers from the existing super funds. So it's really the same as just doing an LRBA arrangement from timing perspective. And I reiterate, like I've always said, let's do the feasibility to start with. Happy to do them at no cost, but let's get that feasibility done. Any any super fund, self-managed super fund that's currently holding a property with an LRBA arrangement is safe, but if you choose to try and refinance, I would proceed with extreme caution, because if these funds are left without a finance arrangement or a company that wants out of that sector, that could potentially create a situation where the property is mandatory going to have to be sold, which may not be in investors' best interest, particularly right now, because we're obviously in the midst of a, dare I say, real estate correction slash, per the treasurer, normal fluctuation in the market. So that's our webinar for this evening. Any questions? Okay. Well, obviously I've been very thorough. So thank you everyone for attending. Everyone's got my email address. Please, if you've got any questions that come to mind afterwards, shoot me an email. Happy to respond to them. Additionally, if anyone would like a feasibility study done on any scenario regarding an ungeared unit trust, we will undertake those at no cost. Happy to, just so that we know if we're going to proceed down that track for anybody, that we've definitely got the resources and we know what we're in for at the start and how the numbers stack up, which is forever the most important thing.